Well, some economists are weighing further rate hikes this year, but Goldman Sachs is already looking to the cuts. It expects the Fed to start lowering interest rates specifically in the second quarter of 2024 and cutting steadily by 1/4 percentage point each quarter until they hit a terminal rate of 3 to 3.25%. Joining us now with his take on the Fed's next move is Greg Daco, EY Chief Economist. Greg, I should say that the Goldman folks did sort of couch this and say the Fed might not do this, but if they want to bring back to normalization, that they would. Would this be the first time that the Fed is not cutting rates as the economy is slowing sharply, but rather just to bring rates sort of back to a normal level?
Yeah, I mean, we know that the paradigm today is one where inflation is still too high for comfort from the Fed's perspective. So they're likely to maintain and hold the current Fed funds rate where it is with a hawkish tilt. I think the window is still open to a rate hike in September. We don't think that's likely to be the case. That's not our baseline. We think they're done with rate hikes. But they don't want markets to be overly pricing rate cuts next year. We do also think that the Fed by March or maybe a little bit later will start cutting the federal funds rate because inflation will have come down so much that will have put upward pressure on real rates, which is really the key focus for the Fed's perspective. We have 125 basis points of rate cuts priced into next year, but that will be a very gradual process. And as you stated, it is one in which the Fed will be very careful as to how much it cuts rates, because the last thing it wants is to inflation to come back and then essentially haunt it and force it to tighten even more.
What role would wages play within that inflation bounce back?
Well, I think the wage dynamic is very important from the Fed's perspective. We still have wage growth that is too high from the Fed's perspective. We have inflation that has come down quite significantly, hovering around 3%, as we saw last week with the CPI data. Core inflation is still a little bit higher, but we expect core inflation over the month of August and September to come down much faster into the low 4%. Wage growth is going to take a little bit more time, but we're hearing from a lot of businesses that in this high cost environment, they're looking to retain talent because they don't want to lay off massively as in the past. But at the same time, they want to protect margins and avoid labor costs being too elevated. That means that wage growth compression is going to be a key factor going into 2024. And I think that will put up downward pressure on wage growth going into next year.
One of the other things alongside wage growth that I know you're watching is productivity, which has been improving a little bit after not doing anything for a very long time. Can you put that in context for us? Why is that important, and which productivity numbers do we need to be watching?
Yeah, we're coming out of a massive and a historical productivity slump where for 5 quarters we had declines in productivity. That hadn't happened in the data series history since 1948. So a significant slump in terms of productivity. I think there is, though, some reason to be optimistic about the outlook for productivity. We have seen that labor has stabilized. We're seeing less churn. So people with more tenure, more ability to increase efficiency in terms of the work processes. We're also in an environment, and this may sound counterintuitive, but we're in an environment where the higher cost of capital means that investments are scrutinized. You're not going to be investing regardless of what the potential revenue can be, as you were in a free money environment. So that is also supposedly going to be a driver of stronger productivity growth. We have the adoption of new technologies. That's also a favorable tailwind. So I think that productivity is going to be an area where we're going to see some improvements. And that may be another driver in this undersupplied world that keeps demand going forward, albeit at a slower pace, but still going forward.
And just to, ask a stupid question here. If productivity is improving, is that just an unfettered good for economic growth? Is that the read-through?
I think it is. I mean, in the current environment where you have still high inflation and you have supply deficiencies across a number of sectors and a number of regions of the U.S. economy, that boost from productivity is really the missing part to the puzzle. Because if you have stronger productivity growth, that's going to help alleviate some of the inflationary pressures, especially when it comes to wage growth. And it's also going to be helping on the supply side. You're getting more supply out of the same type of investment. The combination of those two factors, greater supply, less inflationary pressures, is exactly what we need to get that soft landing that everybody's been hoping for. And that recession that used to be unavoidable may be avoidable if we are in this environment where there is more productivity growth, stronger demand growth, albeit slowing, but still moving forward. And that could help us avoid a situation where the Fed needs to tighten excessively and push the economy into a recession, break the economy essentially to bring inflation down.
Greg, you talked about, and I'm trying to read between the lines here, you mentioned technology that could improve productivity and that perhaps helping alleviate some of the business pressures that are out there, helping as well on the wage side of the dynamic. Are you talking about generative AI, or is there's something else that businesses at large are thinking about investing in or are actively investing in on the technological front to improve productivity?
Well, of course, Gen AI is one of the key elements that we're watching very closely and has that potential to boost productivity growth, but it's going to take some time for the adoption and the diffusion of that technology to be incorporated into day-to-day business processes and therefore boost productivity. So it's a gradual process, but you're seeing more investment in a number of areas that are supported by government policy. You're seeing that the Investment in Jobs Act, the IRA, the CHIPS Act, are all crowding in private sector investment when it comes to semiconductor activity, when it comes to electric vehicles, when it comes to electronics and computers. You're seeing big boosts in terms of construction. That is also an avenue through which you're going to see that productivity growth. So again, this idea of an undersupplied world is one in which you can continue to drive investment. You have to be careful because the cost of capital is higher, but that means that only very good, very productive and profitable projects are going to come through. And over time, that should be a tailwind in terms of productivity growth.